Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video we are looking at 5 different companies that are high growth companies, and all of them are undervalued at the moment. Okay, yesterday's video we talked about 5 dividend paying companies that are undervalued. Okay, we looked at the S&P 500. We identified 5 companies that you could potentially look into and do more research of that were paying dividends. In today's video, I want to talk about high growth, meaning these companies are expected to return double digits in the next few years. And when you think about the bigger picture and how the market has been doing in the last few weeks, right, you would think that's almost impossible, especially if you look in the last 3 months. There are a lot of the technology companies. Look at how amazing this looks. Okay, Nvidia, I think today crossed that $1 trillion market cap, which is absolutely insane if you think about it. Right now we're looking at about 400. It wasn't not long ago that we were looking at 120 and saying it was overvalued, and right now is in the 400. Another company, Broadcom, which is basically some point today, this company, I think it was, let me see, I think, look, it was 900, over 900 per share. My average is 483. That's like double, right? And then look at it now, it actually come back down. So this shows you, look, from 900 to right now 815. This is how volatile the markets can be easily. It could be up and down 1 minute. So what I want to do is I want to find 5 different companies that are high growth, but these companies are undervalued at the moment. Okay, you, as always, you're going to have to do your own research and make sure that you're comfortable with this type of business, okay, before you invest in them. But I'm going to give you the information. What you do with it is entirely up to you. But before we do that, please, if you can join us on the Discord, if you can join us on the Patreon, that will definitely help the channel, like I've always said to you guys. And you get access to all the spreadsheets that I use that you could use for your stock, for basically tracking your stocks and so on. Right, I don't want to make the video any longer, so I want to straight away get to the point. Let's have a look. So the things that we're looking for is the company name, Morningstar, basically economic moat rating. We look at the price, we look at the EPS, we look at the PE ratios, we're looking for PEG ratios. When we do look at these companies, we're looking for PEG ratios, okay? We're looking for price to sales, and what these things mean is this, okay? A lower PEG basically ratio is generally a better indicator of a buy. So for example, if it's a PEG ratio under 1, suggested that the stock price is not currently accounting for the basically expected earnings growth. So people basically are not looking at the future of the company and saying, you know what, this company is growing this much, so lower PEG ratio under 1 is actually good. Anything above 1 is a little bit too much. Okay, price, the price to sales is also the same. So ratio is valuation ratio that compares companies' stock price to its revenues. Is an indicator of the value that the financial markets have placed on each dollar of the company's sales or revenues. So while the ideal basically ratio depends on the company's industry, the basically price to sales ratio is typically good when the value falls between 1 and 2. So anything between 1 and 2, that's basically what we're looking for. If it's below 1, so ratio value less than 1 is even better. Okay, and we know what return on invested capital invested is, and obviously profit margins. Okay, so the next one is the current ratio, which helps us to know if the companies actually have enough money, enough basically liquid cash or whatever to pay off any liabilities in the next 12 months. We're looking for free cash flow, obviously, which is important to us. And then the yellow bit is the bit that I think is important to these companies, which is the total return in the last 10 years if the company has been around for that long, growth estimates for the next year, and then every year after that for the next following 5 years, Morningstar valuation, and then fair value. Okay, so that's what we're looking for. And the first company we're looking for, to basically looking at today, is TSM. Tower Semiconductor is one of the companies that I would love to own, but I can't own it within basically trading 212 because of the ISA account and how it works or whatever. This company will definitely benefit from the situation that basically Nvidia is going on. Nvidia is now becoming the company to go-to company basically when it comes to AI. And the reason for that is their GPUs are already helping companies develop their AI technology side of it. So they're using those chips from Nvidia. Everybody that said that we're doing something to do with AI is going to Nvidia and buying these products. And that's why it's gone up so much in the last few months. But Nvidia does not actually produce these, they can't manufacture it. Who do they go to? They go to TSM. So they will benefit. They will definitely benefit from that. So they have a wide economic moat, $100 per share, $102 per share right now. EPS is $6.43, and price to basically in price to earnings is right now 15.88, which is quite low for a technology company. But a PEG ratio just basically 3.39, price to sales of 5.8. So when you look at this, it seems a little bit expensive. But everything else, profit margins, return on equity, current ratio, everything is perfect. So they've got $17 billion in the bank right now. Total return the last 10 years, we're looking at about 20%. And this is the reason why maybe this company is actually seem to be a little bit expensive, because next year, so they're expecting the earnings to grow about almost to 22%, and then 22% every year after that. Right now, they're 26% discounted, and $139 per share is where the price is at. This is definitely one of the companies I used to basically own, and definitely looking at it again. But the only issue, and I will basically mention this, is the situation between China and Taiwan. That situation can change a lot for this company, and that's the only risk I can think of right now. The next company we're looking at is Palo Alto Networks. This is one of the cybersecurity companies. We've talked about it before. It has wide economic moat, $212 per share. It has basically just started becoming a positive. It started having a positive earnings. PE is very, very high for that reason. PEG ratio just above 1, and price to sales just basically above 10. Profit margin and return on equity. Profit margin is almost non-existent, but return on equity is actually quite good. Current ratio is just below 1, but they still do have $2.7 billion of free cash flow if they want to use that money. Total return in the last 10 years, basically we're looking about 28%, and growth estimated for next year is about 17%, and then almost 34% every year after that. Okay, and this is the reason why I've included this company. Now it's discounted about 6% right now. 225% is basically where $25 per share is where the price should be. The next company we're looking at today is SAP, basically SE. This is one of the companies that started because of IBM back in the days being the monopoly, but monopolizing the markets when it comes to databases. I think they're a German company, or they trade it in Germany. I can't remember. It has a narrow economic moat, $130 per share. EPS is $1.85. PE is about 70, which is very high. PEG ratio is just above 1, and price to sales of 4.49. Profit margin and return on equity is not great right now, but they have enough to cover their current liabilities. Free cash flow of $4.62 billion US dollars. Total return in the last 10 years, we're looking at about 7%. Growth estimate, again, this is the reason why I've included this, is about almost basically 18% in this next year, and 22% the following basically years, the next 5 years. Right now is 1% premium, so that can easily change. So it still feels fairly valued. $130 per share is where it should be, but right now that's where it is. So right now is basically almost a flat if you think about it. Then final the two more companies we've got. Next one is MasterCard. Again, it's a very profitable business. We know it has a wide economic moat, $367 per share. EPS at $10. PE is basically 36, which is basically on average, this company is looking about 35 or so. So this is not huge when it comes for this company. But PEG ratio just above 1.5, which is fine. Price to sales, we're looking about 16, so that seems very expensive. Profit margin, return equity, this is absolutely amazing for this company. Current ratio is above 1, and they have $10 billion of free cash flow right now. 21% growth in the last 10 years, so total return in the last 10 years. 18% growth estimates next year is for 18%, almost to 19%, then 20% every year for the following 5 years. Again, remember, this is estimation. This is not done deal if you think about it, okay? But Morningstar is saying basically it's about 4% discounted right now, $389 per share. You have to be careful with these things, okay, because of this sometimes, right? So for example, what's happening with Nvidia now, everybody's coming out today and yesterday and the day before, well, the whole been almost 2 weeks now, and they're predicting the prices to be 600, 800. So they're pulling a lot of the earnings forward. So it's not going to go higher than that. So we're already saying it's going to be 600. And if they make the $11 billion that they say they're going to make in the next quarter and Q2, then there's nothing else after that, unless they then come out again and say, okay, next one we're even going to do better than that. So we're pulling forward a lot of that, and I'm worried for investors that are buying this stock right now, because if you pull forward a lot of that and then the earnings come out, and also obviously the guidelines from there onwards is not as great as people think it would be, then you basically you're in trouble. Okay, but with this type of company, you have to be careful with these estimations. Okay, so this is just estimation from analysts as well, obviously. Next one is Tesla. You might be surprised to see Tesla being undervalued at the moment, but it has been undervalued for quite a bit. It has a narrow economic mode. $200 per share is where the price is at. $3.40 is what they make right now in terms of EPS. PE seems a little bit high, but price to, when you look at price to earnings to growth, or PEG ratio if you like, 1.6, which is not a lot, and price to sales is actually 6.21. So looking at this list is actually not bad in comparison to the rest of the companies. And profit margin, return on equity, there is actually getting there. Current ratio is perfect. They've got $5.78 billion of free cash flow, 40% return in the last total return in the last 10 years. Growth estimate 41% next year, and then 11% after that. 10% discounted right now. $215 per share is where the price should be. Every single one of these companies is Sharia compliant. Okay, in terms of their business side of it is fine. In terms of business interest bearing debt is actually fine. This company is the only one that has just a slightly higher interest bearing debt. And then when it comes to interest bearing security, they basically Taiwan Semiconductor is the only one that has about 13. But remember, the cutoff is about 30, 33, depending on what you're looking at. So that is the 5 companies that I wanted to share with you guys. So there are opportunities within the stock market right now, although things might seem gloomy some days, and you look at it. For example, today when the markets are open, these companies were doing absolutely amazing. Everything was green. Right now it's coming back down again. I think both the Nasdaq and S&P 500 and the Dow Jones are both right now in the red. But when you look at the rest of the companies here, I will be looking at a lot more this weekend, inshallah, coming. I'm going to look at the other companies that we haven't spoken about that potentially might have come down, because there are companies that are down almost 5-10% just basically in like the last 5 days or so. So we're looking for opportunities, and sometimes I'm looking at my portfolio and thinking, what can I actually buy? So companies that have done absolutely amazing and gone up so much, I'm not going to touch those. Okay, because remember, actually one of my mates said to me today, why don't you take these £2,000 and sell Broadcom, just basically sell it the £2,000, just take some profit. And I remember reading an article where Peter Lynch, which is one of the greatest investors out there, it said it would be basically more or less dumb to actually sell your the companies that are doing really well and keep those who are not doing well. I can't remember, I'm kind of paraphrasing. So I always think about this, but again, this company is reporting soon, and if they report and the price goes to again 900, 950 or whatever it is, I will definitely take some profit off the table, because again, that's no one has ever lost money basically taking profit, have they? So I will definitely do that, even if that means that I take £2,000 off the table completely, buy another company that's undervalued. And there are quite a few companies that are undervalued at the moment in my portfolio. One of them is Qualcomm. I believe Qualcomm will do absolutely amazing in the long run. Okay, so take £2,000, bang in here, and you get nice dividend as well as obviously UPS is another one, and S&P Global. So I've got loads company that are undervalued at the moment that I could potentially add to. So anyway, I will be doing portfolio updates very soon, inshallah. I will share with what's going on with the portfolio. If you like this type of transparency, what we're doing here, please like the video, subscribe to the channel. Let me know if you have any questions. The website that I'm using, I know some of you asked me, I've actually answered your questions. This website is Vinvis. I will actually put on the link in the description so you can just use that. And the other one that I was using, this one is basically simply save dividend. Okay, so that's where I get this sometimes some of these informations. So I hope you're enjoying the videos. If you are subscribed to the channel, let me know if you have any questions. Join us in the Discord, join us on the Patreon account. Have a wonderful day. Assalamu Alaikum.